Okay, let's get started. This is Manesh Patel. I'm the professional educator for Valetax. I want to welcome everyone and taking the time to attend today. I'm hoping this will be a great workshop for you guys and you enjoy it. It is interactive workshop, so if you do have any questions, please stop me as we move forward. You could unmute on the mic and then ask any question you like. You could also type it in, but if you can, just ask the questions as we go forward. Today's workshop, we're going to talk about money management. This is a foundation for you to be consistently profitable. This is something that I love to talk about, and it's something that not many people talk about at all. And you have to have really good money management skills in order for you to turn the corner from being a retail trader to a professional trader, to an institutional trader. Without money management, you still always have a high probability where you could lose everything in your account and you could go to zero. With money management, the chances of you blowing out your account are very, very low. And you'll see that as we move forward. One of the things you'll realize is that without money management has to be the foundation for your trading. So before we begin the money management, I just want to briefly go through and talk about me, who I am, and so forth. You could find me on the web everywhere. My specialty, believe it or not, is in Ichimoku. However, I'm certified, so technically I know all the technical systems out there. I'm part of a global institution called Chartered Market Technicians, which is a 4-year certification process you go through to learn all the technicals and fundamentals. Institutions hire straight out from there. But a little background of myself, 1996, I graduated my master's in engineering. I went down two paths. I was an engineer for 16 years in telecom, but my passion was in trading, so that's when I started learning to trade. I rode the internet bubble up as a young kid, retail trader, and in 2000, when the bubble busted, I lost it all and even went into a margin call. And it was a big reality shock, especially with me being an engineer. I thought technical analysis was everything, and it wasn't. So I took a little time off, regrouped, and then basically came back and took all the various technical courses around the world, um, including fundamental analysis and stuff like that. Long story short, had a great track record where basically I got picked up to manage money back in 2000, late 2006, 2007. Went to work to manage currencies. Eventually, 6 months later, I took over as CTO for that firm and helped to create machines that did 40,000 trades per second. In 2010, I left Wall Street, pretty much be managing my own money today, and pretty much helping retail traders turn that corner to become professional traders. Trading has been a great gift for me in my life, and that's something I want to give back to everyone. And that's one of the reasons why we're going out and doing all these different workshops and stuff like that. This is the first of many workshops we're going to be doing, so hopefully you guys will enjoy them, give me feedback. And if you do want to see a workshop on anything out there, any system, any fundamental analysis, or anything else, please let us know and we'll go ahead and schedule it and go forward from there. So as I mentioned, today's topic is going to be money management. There's two different thought processes for money management. The very first thought process you have is from a retail trader. When they think of money management or anything at all, they look at things, their system, their way of trading, and other people's systems based on the win-loss ratio. They try to achieve a 100% win-loss ratio. So you see a lot of advertisements out there that say, we got 96% win ratio, 98%, and so forth. That's a retail perspective where retail people only think about win-loss ratio. To obtain a high win-loss ratio, you have to risk more. Okay? It's a yin and yang between risk versus win-loss ratio. There's no perfect scenario out there. A lot of people think there is, but there isn't. And there's really no 100% winning system out there. If it is, then everyone would be doing it, and then really you go nowhere. Okay? And in that system where you have a high reward win-loss ratio, you typically average around a 1-to-1 risk reward. Okay? And we'll talk more about this in great detail as we move forward. The institutional perspective is very, very different. They don't really evaluate a system, evaluate themselves as traders based on win-loss ratio. They evaluate themselves based on reward risk. To an institution, risk is the biggest thing they look at. It's not the profit part because they believe the profit will come. The key is managing the risk, and that's very, very critical. So if you ever want to go work for an institution and you have a track record, the biggest thing they're going to look at is your reward risk for your overall portfolio that you've had quarter by quarter or year by year. So they evaluate based on reward risk, not your win-loss ratio. Okay? And basically for them, quality of trades matter versus quantity. So you see a lot of robot trading that's going on, this and that. So quality versus quantity is really what matters to the institution. Okay? So we're going to look at money management and systems based on two types of market environments. The two market environments you typically see is one is the consolidation pattern where markets go back and forth, back and forth. There's a lot of volatility there. Sometimes there's very little volatility, but either way it goes back and forth. Really doesn't go in a continuous path, either going up or going down. Just goes sideways. During consolidation patterns, that's typically when a lot of systems fail. That's when your losing becomes huge and your winners become small. And at that point, a lot of people struggle trying to make money. And some people also start to lose a lot of money to a point they can't come back from. So we're going to evaluate a consolidation pattern in the market, which is a worst case type of scenario. And we're going to assume that you have a 70% win ratio and 70% loss ratio and 30% win. So that's a little backwards there, okay? So this is what you're going to be looking at in that system. So if you evaluate the system here, your reward, if you have a system that's typically a reward risk of 1-to-1, then what's going to happen is you're going to have 3 winners, which at that point you make $3. If you have 7 losers, you're going to lose $7. Net, you lose $4 overall. This is for a consolidation system, okay, where you're going to have 3 winning trades and 7 losing. And that's typically a lot of technical systems, especially if they're based on moving average or any indicator that's based on closing price, you're typically going to be around a 1-to-1 reward risk ratio. So this is typically what a lot of people face with their system. If you look a high win-loss ratio system that's now getting into 85%, 90% win-loss ratio, you're typically taking on more risk, okay? So here, you're typically risking $1 to make 50 cents, and that's typically what your goal is. You'll see some people say on a monthly basis, we could give you a 10% return, 12% return, those type of things. In those scenarios, they're taking on huge risk. If you run the numbers for the consolidation pattern with the 3 winning trades, you're going to make $1.50. With a loss, you're basically going to lose $7. So net, you lost $5.50. Okay, so in both these systems, which are red here, you're risking more than you're trying to make in the reward, and that's not a good scenario at all. If you look at the other system, which is really the key that needs to be your foundation, is a system that gives you a reward risk of 3-to-1. So your goal is to risk $1 to make $3, and that is what you're trying to do here. If you run the numbers for that system, with 3 winning trades, you're going to make $9. With 7 losing trades, you're going to lose $7. Net, you're basically going to gain $2. Okay, and the big theory from the institutional perspective is that when you have a reward risk system of 3-to-1, your goal is to kind of break even. You may make a little money, may lose a little money. It doesn't matter, but your goal overall is to minimize the risk to a point. Net, you come out with break even. Okay, so even if your win-loss ratio is lower, it doesn't matter. You're still going to be close to 0, which is what you're looking for. So during the consolidation pattern, a system that's designed for 3-to-1, its goal is to stay at break even and buy some time until a trend starts to occur. Okay, now we're going to take these same scenarios and we can look at a trend pattern. In the trend pattern here, this is where we're going to have 70% winners and we're going to have 30% losing trades. So we're going to have 7 winners, 3 losing trades. So if you run the numbers with that, with a reward risk of 1 to 1, now what you're facing is that the winning trades will give you $7 of profit, losing will give you $3 a loss, net, you win $4. So here, now you start becoming positive when the markets are trending. When the markets are trending, that's when you should be making the biggest amount of money. And that's really the goal there. So that when the markets are consolidating, your goal is to stay at break even. The markets are trending, that's when you should start to make money. If you have a inverted reward risk ratio where you're risking $1 to make 50 cents, now what's going to happen is with the winning trades, you're going to make $3.50, lose $3, and net, you gain 50 cents. So this is not a good scenario at all. But some people are doing that and they're happy with it. That's fine. But the key is that when the markets consolidate, if they consolidate a lot, you're going to lose a lot and you're going to dig a hole, which is going to be very, very hard to get out. The last system, which is a 3 to 1 reward risk system, this is when the reward really starts to come, because your 7 winning trades are going to give you $21 of profit and your 3 losing trades are you're going to lose $3 to a point you basically make $18. So the 3 to 1 reward risk system is the basic that you need to maintain in order for you to be consistently profitable. And that is the foundation for what you should be doing. Okay, so let's talk about that 3 to 1 now that we proved that the 3 to 1 system is great for trending markets and consolidation markets. So it covers all the scenarios out there. So how do you achieve this 3 to 1 reward risk ratio? That is the magical question. Okay, so first you have to design your technical system with money manager as your foundation. A lot of people look at technical analysis, they look at moving average systems, they'll think about the moving average system, but then they don't think about a reward risk at all. And you should be looking at the money management to be the foundation and then building your technical system around that thought process. Okay, and we'll give you some ideas of that in just a moment. So your goal is to keep the risk low and the reward high. So now your technical system, this is where you typically use indicators. So you need to use indicators to find key support resistance values. Okay, that is the main thing. The purpose of an indicator is to find where these price can stop and then it could start a trend, or it could bounce off there to start a trend too. So finding the key support resistances is the whole purpose of using indicators. Okay, then you have to do money management. So in your system, you're going to know exactly where to place the entry. Okay, so you're going to use your indicator to find where that key support resistance value is, and then you're going to place your entry close to that support resistance value. Okay, so that you're going to know what your entry is. Then the goal is to keep your risk low from that point. The closer your entry to that support resistance value, the lower the risk. The higher the way from the support resistance, the bigger the risk you have. Okay, so reward. So this is something I talk about over and over, and I've been doing this for years. And one of the things I've learned with time, and I started off as a retail trader and moved to institutional. And with my engineering background and programming, I went into technical analysis in great detail. One of the things I realized is that you can't achieve a 3 to 1 reward risk system with a system that's designed with an indicator that's based on closing price. A perfect example is moving averages. Okay, and the reason why is that in order for the moving averages to move, it goes on the closing price. You have to wait for the bar to close. If you're waiting for the bar to close, you're going to give up some of the reward. And if you give up the reward, you now have a potential of not even making a 2 to 1 or 3 to 1 at all. Your probabilities are pretty much 1 to 1 at max with a moving average system unless there's a lot of volatility there, which is a black swan event. So my suggestion to you guys is that use a technical indicator that's not based on closing price, okay? And that will help you a lot in achieving the 3-to-1 reward risk ratio, okay? Use an indicator that's based on highs and lows, and that's going to be the perfect scenario. We're going to have a couple of workshops where you could trade off pure price action based on highs and lows. We're going to talk about other technical systems too. We'll look at Ichimoku, which is my specialty, believe it or not, and other things too. And we'll show you the advantages like that you have of those systems versus systems that are based on closing price. Okay, so the biggest thing is that your entry needs to be closest to the support resistance. So you know exactly where your entry is going to be. Your stop, your conditional stop will be a buffer away from that support resistance. So you know the risk is from your entry to your conditional stop that defines your risk. Once you know what that risk is, you could then triple that risk and add it to your entry, and that gives you a 3-to-1 target. Okay, so you always want to try to achieve a 3-to-1 target based on your technical system. And we'll show you some examples of that in a couple of minutes. So that concludes the money management part of our presentation. The second part of the presentation we're going to talk about is trade size. So money management, we came to the conclusion that you have to achieve a 3-to-1 reward risk ratio. If you do, then you could pretty much trade through any market condition and you'll be perfectly fine. Okay. The second thing we need to talk about is trade size. This is critical where a lot of retail traders do not think about this, but you have to. If you are not thinking about trade size, you're not really trading, you're gambling. And that's the key thing. Trading is all about probabilities, and trade size is the key to trading the probabilities. So if you do not have trade size at all involved in your system, then now you have a high probability where your losers can take control of your account and your winners will pretty much fade away. And at that point, you'll continue to keep on losing. And that's something you don't want to do. So you want to look at trade size there and go from there. So let's get into this discussion now. So why is trade size important? I already highlighted a little of it, but it allows you to trade probabilities. That's the first thing. Second, without trade size, you're gambling. Third, allows your winners to take care of your losers. So if you're not looking at trade size at all, then your winners can take over your winning trades. And at that point, you're going to keep on losing in your account overall. And you don't want that to happen at all. You want your winners to always take care of your losing trades and you come out profitable. And that's the key thing. Number 4, you also trade size is important for copy trading. So if you're involved with copy trading, trade size is the most important thing there because you're trading probabilities and so forth there. So we're going to go through the methods of trade size in just a moment. Position size is dependent on initial risk. So just like we talked about 3-to-1 reward risk ratio, you know what that risk is. Position size is going to use that risk to determine how many positions you should be taking on into that trade. Okay. And if it says here, initial risk is entry minus the initial stop, which is your conditional stop. So we've talked about that already. You know where you're going to enter. You know where your conditional stop is. The difference between those two values is basically the risk. There's many different methods of trade size out there. Today, we're going to go for the 2 most popular methods that most people use and the ones I recommend. The very first one is using a fixed risk, and the second one is using a percentage-based risk. Okay, so let's go into details of both of these. The first is the fixed risk. In here, let's assume that you had $10,000 in a trading account. What you're going to do is you're going to have a fixed risk. So we're going to say our risk is only going to be 20%. That means at one time, I could at most risk only $2,000 of that 10,000. That means 8,000 needs to just be in the account doing nothing. So you cannot put on more trades where you're risking more than $2,000. So that is it. Now, why did I come up with 20%? Most people are allocating 50%, 60%, 80% of their capital in the market. If you think about it, if you get a black swan event, it could take you out and you're going to lose majority of your capital. If we get a black swan event and you only have 20% in the market, now you have what? Still the 80% there that you could trade and keep on coming back. Okay. The other thing is that we are not like everyone else that's looking for a reward risk of 1-to-1 or lower. Our reward risk is 3-to-1. So let's say that you achieve a 3-to-1 with that $2,000. If you do, you made $6,000, and that, if you think about that, that's a big percentage of $10,000. Okay, that's 60% of your account increase that you got with just looking at a 3-to-1 reward risk ratio on the initial 20%. So the goal is to have less money in the market, and the reason why is that you're looking to achieve a 3-to-1 reward risk ratio, which will give you the capital gains. Okay, so quality of trades versus quantity is the key. Okay, so if you look at this scenario here, you have the fixed risk right there. And let's say that you've been trading and you know that you're going to have maximum 10 trades at one time. With a copy system, you know those statistics. With your technical system, you probably have a good idea there from real life trading or back testing. Let's assume you're going to have 10 trades at one time on. If you do that assumption, then your risk per trade is going to be $200. So now I know what my fixed rate is, okay? So I'm willing to risk $200 per trade, and I could have 10 trades at one time. These are my parameters for my system, okay? So now we're going to go, and we're going to look at a technical system. This is the Ichimoku system. Some people call it cloud system. You may have heard of it, you may not. It's one of the most popular systems out in Asia and really popular around the world now. But it started off primarily with currencies. But in this system here, this is where it comes out of the cloud. When it does, you're looking to enter here. Our initial risk is going to be right here, and then our target's going to be here. So if you look at this very closely here, and we're assuming our risk is 12 pips here, and if you look at everything here, the risk is basically from your entry to that conditional stop. That's 12 pips. We added 1 pip for the spread. And remember, don't forget about the spreads in currencies. So our initial risk is 13 pips, okay? We know this is a 3-to-1 reward risk ratio. So the 3-to-1 will give you 37 pips. So our initial risk is 13 pips. Our reward is 37 pips, which is the 3-to-1. We know that we could allocate $200 per trade. So if we're risking 13 pips for in here, $200 by 13 now gives you the ability to do 15 mini lots. Okay, so this is how I determine this. So when I trade, I'm not going in with a fixed number of mini lots or quantity size. My quantity size is determined from my risk on the charts and my risk per trade. So in here, I'm going to do 15 mini lots. If I get to my target here, I'm going to make $195. Sorry, my risk with the 15 mini lots and the risk of 13 pips, I'm risking $195. If I get to my target, I'm now making $555 in profit. Okay, this is a reward risk, little less than 3-to-1. Okay, so here you need to make a little adjustments here where the reward, the target needs to be a little higher here to cover the spread here, which will then get you 3-to-1 reward risk ratio. Okay, so you always want to make sure you are aiming to get to 3-to-1 reward risk ratio. Okay, so here we're trading. Now this is trading, it's not gambling. If you have a fixed quantity size all the time, then you're not really trading probabilities, and you really need to rethink that process. Okay? This is one thing institutions do the best, and this is one thing retail people don't do that well at all. Now, this is how you're going to trade here. How do you make adjustments? When do you increase the risk per trade? Because if you're making money, your goal eventually is that now if you look at the 20% of your trading account, your capital is not $10,000. Let's say you made money, it's now $20,000. 20% of 20,000 is now going to be double this. So when do you start changing your risk per trade? My suggestion to you is evaluate every quarter. So at the end of every quarter, just like institutions do, you look to see what your capital is, and then you could say 20% of that is this much, 10 trades, now my risk per trade is going to be this much. Okay, so adjustments we always suggest you do on a quarterly basis, from risk per trade, the maximum number of trades, and so forth there. Okay, remember, if you have any questions, please stop and ask me. So this is one method. The second method is where you have percentage-based risk. Okay, in here we're going to use the same thing, $10,000. 20% is going to be in the market. Now instead of a fixed quantity size or anything like that, we're going to say maximum risk per trade is going to be 2%. Okay, so it's not a dollar value, but it's going to be 2% of my capital. Okay, so if your capital is increasing, this will automatically increase too. Okay, if it's decreasing, then the risk per trade is going to be lower. So if you look at the numbers here, the initial risk is going to be $200, which is basically 2%. And you look the same thing on the chart here. So same thing you have here is 13 pips risk, reward is 37, and so forth. Okay, so now once you get to the target, you now made $555. So now your account value is $10,555. So next trade now, you could evaluate this and you could sit there and have a higher dollar here. Okay, so this varies and so forth. This becomes a little complicated for people. Reason why is that you have to continuously keep on looking at your capital size and capital and looking at the percentage and going from there. So a lot of people are continuously doing that. Some people will only adjust the 2% of your capital at the end of the quarter. So there's many other different methods that you could do and incorporate with this, but this is just some suggestions. If you're starting off in trading, as most people are, then I would probably stick to doing the first method, which is the easiest one, which is the fixed rate right there, which gives you a fixed dollar amount per trade, and it makes everything very, very simple going forward. And then you evaluate yourself at the end of the quarter, because initially as a retail trader, if you're just beginning, you could have more losing trades than winning, and this is very easy to a point you don't have to think about that. Okay? Is there any other questions? Do you guys have any questions for me? Did you find this useful? Sorry, I'm just getting to the chat. Just bear with me. Okay. Yeah, so if you have any questions, feel free to contact me. Like I said to you, it's not the exciting subject at all. Most retail people don't even look at it. It's boring. No one even teaches this, believe it or not. But until I actually became successful, it wasn't until I learned money management. I went down a path of technicals, and eventually you get on the trend, you do fine. So there's moments that you're making good money and you feel confident and everything looks good. But when the consolidation pattern comes, and depending on how long it is, then that's when you start losing money and you give back all your profits, and then you could even go negative. And remember, times are changing where volatility is here. There's more machines in the market now doing high frequency trading. So you're now competing a lot with not humans, but more towards machines. So this is where money management is now going to become more and more critical. So as volatility increases in these markets, money management is going to be very, very critical. And that's where retail people are going to lose more and more money if they don't start to incorporate it in there. Okay. You had a question, what about drawdown? Drawdown is that risk, right? So the drawdown is basically if you're betting on something going up, then the drawdown is before it goes up, it's going to go down. So a lot of people call that the drawdown. So your risk, your conditional stop has to cover the drawdown, okay? And so now how do you do that? Well, it all starts from the indicators, okay? Your indicator's sole purpose is to find the support resistance, the critical ones, the institutional ones, the key values. Once you know what that level is, if you're looking to buy, then what you're going to do is you're going to have a buffer above that support resistance level where you're looking to buy, okay? And then your stop is going to be another buffer below that level. So your drawdown below the support needs to not get to your stop. Okay, so the buffer off the support resistance value is very, very critical. What are these indicators? Well, Calvin, you could use any indicator out there. There's tons of them out there. The most popular ones are the moving average systems. Then a lot of people start incorporating RSIs. There's even chart patterns like pivots, Fibonacci, and so forth. October 30th, we're actually going to do a presentation on Fibonacci. So that's where we're going to go from one system and talk about the reward risk there. We're going to show you the Fibonacci, which is the most popular technical system in the world. We'll go through that. I'll show you the pros and cons on it. I'll show you how to improve on it and stuff like that. And each of the presentations we go through on technical systems, we will be talking about money management 3-to-1 on each of them. So you'll see exactly where the system says you buy here. You'll see the stop that we use. How did we get to that conditional stop? And that's your risk. And that risk covers the drawdown it could go through. So you're predicting how much drawdown it's going to have, and then you're adding a little buffer to avoid getting stopped out. Does that help? In the next workshop, we're going to have a lot of visuals or charts and stuff like that. And I think it'll be very, very clear in that workshop, because if you look at here, when you start talking about money management and trade size and all that, it's a numbers scenario. It's not too much visual at all. So it's very hard for people to visualize and kind of understand sometimes. So when you start talking about a technical system and you see the chart and it tells you here's your entry, here's your stop, and here's your target, now you could understand what the reward risk is. Then you can understand trade size and so forth. So it makes it very easy to do. Yes, you're completely correct. During critical events, a lot of slippage can occur. And in fact, you get the slippage, the spreads will increase and all that too. So you do have to incorporate all that, right? My thing to you is you kind of know during an event how much the spreads are going to increase. And you could look at different events and you could see the spreads increasing by 5 pips, 10 pips, and so forth. That means that's what you're going to have to think about when you're trading. So when you're looking at that risk, we added in the charts a 1 pip risk completely, okay? And if you look at that, right, add more pips there, see what that risk is, so you start looking for a higher reward, okay? But you have to maintain that 3-to-1. So if you incorporate the slippage into your risk. Okay, how about trailing profits or risk? Yes, you can do that. Remember, we're just talking about the foundation when you're looking to enter a trade. Once you enter the trade, then I do suggest you go into a trailing profit and trailing risk. And let me give you an example of what we do and something that's consistently, and this is what helps a lot of people. You're trading off a particular time frame. Your system tells you to enter. On the very first bar, let's say it's a daily time, or let's say it's a 2 hour time frame. You enter on a 2 hour time frame. At the end of that 2 hours, you have to be profitable. If you're not profitable, my recommendation is get out right away. Don't think about it. Reason why is your technical system, you did all this research, everything. Your system says go. If it says go, at the end of that bar, if you're not profitable, it's not going to go. It's a high probability it's not. So at the end of the first bar, you exit the trade. It's a minimum loss, it's a loss, it's minimum, but it's good. Now, after the first bar is profitable, if the first bar is profitable, you stay in it. Second bar, you want it to be more profitable. Listen to my words, more. If it's not, get out of the trade. Don't think about it, just get out of the trade. Okay? We always go for, and this is something I've done that turned me into institutional traders, I go for a 2 bar validation. I want the first bar to be profitable, second bar to be more profitable, and then on the third bar, I go to break even. That means I take my risk, I move it to where my entry is, and there's no more risk at all. Okay? By doing that, now what happens is, remember that the charts we went through, risk per trade, I can only have 10 trades at one time. Okay? Well, the moment I change my stop to break even, the risk is 0. So if I filled up my account with 10 trades and I can't do any more, and these trades now went to 0, it now allows me to take on more trades. Okay? There's no risk. And now, then you could start using a trailing stop, okay, after the break even. But what's the point of using a trailing stop if you haven't got the break even? Because you're not allowing it to breathe. You're not allowing it to move. And that's the biggest thing. And I want everyone to think about this. You've been trading for X number of time. You think about this. Just a simple concept of going to break even on the first bar. If you had done that, where would you be today? How profitable would you be today? And you'll see that's a big, big difference. In fact, just doing that first bar, getting out, if you're not profitable, your probability of you blowing out your account goes very, very little. And the idea, when you start doing that, the chances you now be consistently profitable is high. That's a simple technique, but a lot of people don't do it. A lot of people don't talk about it, but that's something I always suggest. In every workshop we hold, we're going to be talking about that. And I'm going to consistently keep on telling you, after the first bar, at the end of that first bar, you have to be profitable. At the end of the second bar, you have to be more. If you're not, you exit the trade. Remember, your goal is not like winning a lottery ticket. Your goal is to be consistently profitable in this business. And if you think about this, if you get your trades to break even, now as it keeps on moving up or moving down, you're getting a residual income. And that's what you're looking at doing, is you want to fill up your account with a lot of break-even trades. Institutions, remember, I told you this at the very beginning, think about risk. So the first thing you want to do is get rid of that risk. Once that risk is gone, I'm not worried about it. I'm going to let the market do its thing. And the trailing stop will basically tell me when the market's done and it doesn't want to go up. Gold's a perfect example. A lot of people right now keep on trying to think where gold's going to stop. Why? Just look at your technical charts, follow your trailing stop, and just keep on going that way. And you got nothing to lose. Do you see what I'm saying? So that's a very, very critical aspect. Everyone good? Any questions? No, because that's all I got for today. Yep. So October 30th is going to be the next class. We're covering Fibonacci, a little more exciting. I think a lot of people love it. Fibonacci's been around for a long time. Just Fibonacci ratios in everything we do, believe it or not. It's the most powerful system out in the world, been for many, many years, but it's very subjective. Okay, so we're going to take that subjectivity out, and I'm going to show you how to do that and what to look for and how to increase your probabilities with Fibonacci. Now remember, Fibonacci is not a technical indicator, it's a chart pattern. So it's the scenario of trading pure price action. Okay, and that's going to be the best part. And one thing I want everyone to remember, whatever system we talk about, whatever we do, I'm not curve fitting. It works for any instrument and any time frame. Okay. So when we talk about anything, if I say daily time frame, it means it'll work for 5 minute, 10 minute, weekly. It works for gold, it works for currencies, works for futures, works for any market in the world. If you could chart it, you could trade it pretty much. Okay. Well, thank you for everyone taking the time to attend this session. Please give us feedback, and I look forward to the next session in a couple of days. Thank you.